We do have a short presentation, which will be education on financial matters, which will be conducted by one of our investment managers, Mr. David Gitau, CFA, and he will take us through just a snippet of investments for the benefit of all of us. David?
Thank you, Stanley. Thank you, Chair. My name is David Gitau. I'm an investment manager at CIC Asset Management. The investment team comprises of the investment managers, the investment analysts who advise us on whether to take up an investment or to avoid them. It also consists of the investment dealers. And just to give you more comfort, decisions are not made by an individual. They are made by the investment committee, which comprises of the investment managers, the investment analysts, the investment dealers, the pension manager, the finance manager, and the risk and compliance manager. Today, the topic of the day will be just to go through one of the strategies or objectives you may have as an investor. But generally, as an investor, you have three objectives. The first one is growth. And basically with growth, you're saying you want to double, you want to triple your money over time. And the key word there is over time. And the two investments that achieve the objective of growth are, one, property, in the sense that you buy a large piece of property and you subdivide it. Subdivision in Kenya, you'll probably get returns of 30 to 40% once you subdivide. So as an investor, you should not be buying eighths, you should be selling the eighths, okay? The other investment that achieves the objective of growth is buying shares in businesses. Those shares can either be public, meaning the ones that trade on the Nairobi Securities Exchange, or they can be investing in your own private business. The other investment objective one we have is income. And with income, we are saying that you want a steady stream of income that is readily predictable. And again, this is looking at it over a long term. And two investments that achieve that, one are treasury bonds, which is just basically lending to government for the longer period, and property in the form of rental property, specifically multi-story dwelling units. But today we'll just do one investment objective, and that is capital preservation. And with capital preservation, basically what we're saying is you don't want to lose a single shilling. The money you put in that investment, the shilling you put in that investment, tomorrow you want to come back and find that shilling. But what is more important at the end of the day is that that shilling or that money must at least grow at the rate of inflation. And the investments that achieve that, the first one is bank deposits. And just to be on the same page, basically a bank deposit is either regularly for 3 months, 6 months, or 12 months. And here basically you're lending money to the bank at an agreed interest rate, which is agreed at the period. And you also agree for how long you're going to keep that deposit in the bank. And basically, so if the bank agrees to give you 12%, you know you're earning 1% per month, and you can also calculate backwards and know how much you're earning in a day. The second investment that achieves the objective of capital preservation are treasury bills. Every so often, government comes to borrow money from the public so that they can fulfill their short-term obligations, e.g. salaries and rent. And basically, the easiest way to describe a treasury bill is if you have, let's say, 100,000, and the government has agreed to give you 10% per annum on that 100,000. So you take 10% of 100,000, which is 10,000. You take the 100,000 minus 10,000, and then you get 90,000. So what the government is essentially telling you is, give us 90,000 today, and we will give you 100,000 shillings later. So you give them less, they give you more at the end of the day. The third investment that achieves capital preservation are what we know as commercial paper. Basically, commercial paper works on the same way as a treasury bill. The only thing is here you're lending to corporates, and typically for 3 months and 6 months. Collectively, these three investments are known as the money markets. And if you notice, they're all short-term, they do not exceed 1 year, and all you earn is interest. So how do you go about investing in the money markets? One, you can go there directly, go to the bank, negotiate with the bank directly, and based on the amount of money you have, the interest rate will vary. But on average right now, the savings rate in the bank is about 4.2% based on the central bank data that has been provided. If you want to buy a treasury bill, just go to Central Bank of Kenya, open what they call a CDS account, and you can start lending to government. The minimum required to invest in treasury bills is 100,000. In terms of commercial paper, I don't expect investors as individuals to go the commercial paper route, simply because of maybe you might not have the time or even the skills to understand and analyze these companies to understand whether they're going to pay you back or not. The other way you can access the money markets is through what we call a collective investment scheme. What fund managers across the world have done is they have created these investment vehicles whereby money is pulled from very many investment or investors. These collective investment schemes take the same or have the same principle as an investment group or a chama, because people come together as a chama so that, because with more money, you have better negotiating power, and secondly, you're able to do bigger things than you would not ordinarily do alone. So how do these collective investment schemes operate, or what is their structure? In Kenya, the collective investment scheme can either take the shape of a company, or it can take the shape of a trust. But in Kenya, most of the collective investment schemes take the route of a trust. And just like a company is formed under the Companies Act, the trust is also formed under the Trust Act. And just like a company has memorandum and articles of association, this trust also has a trust deed, which dictates how the trust will be run, and also another document called the Information Memorandum, which talks about where the money in this trust will be invested. So typically, just like a company is a separate legal entity, this trust is a separate legal entity. And in as much as it, for example, the CIC Unit Trust Scheme, in as much as it has CIC's name, it is a separate legal entity from CIC Asset Management, and also, even from the wider perspective, it's a separate entity from CIC Group. So you're not putting money in CIC or CIC Asset Management. You're putting in your money in this trust, which is a separate entity altogether. Again, something that may shock you is that in as much as the trust is called CIC Unit Trust Scheme, the boss of the trust is actually the trustee, in this case, KCB. The trustee is the one who holds the assets or all the investments in trust for all the other investors. The other service provider to this trust is the custodian, in our case, Co-op Bank. The custodian's work is to keep all the records of all the investments that the trust makes, and to keep all the documents of title of all the investments. So if this was a property trust, the trustee is the one, or rather the custodian is the one who will be holding the title deed. All money is paid to the custodian, and all money is paid out by the custodian. Again, no money comes into CIC. The third service provider is now the fund manager, CIC Asset Management. The fund manager's work, one, is to give investment directions or instructions as to where the money will be invested. Secondly, the fund manager also does administration, meaning the day-to-day updating of accounts of investors, making withdrawals, making sure that statements have been sent at the end of the month. That's the work of the fund manager. Now, because this trust is a separate entity, it has to prepare financials, and those financials are prepared by the fund manager in conjunction with the trustee. Now, because these are pooled investment schemes, and money in that scheme belongs to the public, government must be involved, and they're involved through the Capital Markets Authority, which is under Treasury. Every 3 months, the trustee will call a board meeting, what we know as Board of Trustee meeting, and the custodian and the fund manager have to report their activities for the last 3 months, in as much as the trustee is seeing them on a real-time basis. Every 3 months, the trustee, custodian, and fund manager have to send their reports to the regulator, and the regulator can visit them at any time. Now, because the trust keeps financials, they must be audited. Last year's auditors were Ernst & Young. This year's auditors will be PwC. Then finally, you have the investor. You put in money into this investment vehicle. The fund manager directs how custodian where to invest it. Now, just like a company, when you put money into a company, you get shares in exchange. When you put money in a trust, you get units in exchange. And that is why it is called a unit trust, and you, the investor, are known as a unit holder. Now, the trust that tries to achieve or achieves the objective of capital preservation, meaning it involves or it invests in the money markets, meaning bank deposits, treasury bills, and to some extent commercial paper, is known as a money market fund. So the money market fund's objective is basically capital preservation. On average, over the years, money market funds will average about 9 to 10%. That's been the average rate. But over the years, since 2015, 2016, we've seen interest rates coming down after the interest rate cap was introduced. In front of you are just statistics as at December 2019, where CIC Asset Management or CIC Unit Trust Scheme was the biggest fund in the country, commanding a market share of about 40%, with approximately 30 billion in assets. Currently, we've added another 10 billion. So currently, we are managing about 40 billion. The risk profile of the money market fund is very low. How can you use the money market fund? One of the most important things about the money market fund that you can use is build your emergency fund there. This has now become very critical, very important, particularly in these times of the pandemic, because people have found themselves jobless, businesses have closed, in fact, businesses that you never thought would close. So it's a very good place to keep your emergency reserves, either as an individual or a company. Educational expenses, you can actually save in a money market fund and pay interest from the interest that you receive on your investment. So you can actually form your own education fund in a money market fund. If you have idle cash that you don't need to use in the near future, you can park it in the money market fund. If you need to save for a project, maybe buy land, or want to start a business, you can actually save in the money market fund. If you need to go on holiday and you need to save for holidays, you can save in a money market fund. And most importantly, this money market fund should be your default savings account. So what are the advantages of a collective investment scheme as opposed to going direct? One is you get higher returns because this is a collective pool of money. So the fund manager has better negotiating power with the banks and with government. You're bound to have higher returns. Currently, the average return now is about 9%, and bank deposits are about 4%. Secondly, you're able to withdraw your money on short notice. It takes you about 2 or 3 days to get your money. If you go to the bank, you're stuck for that period that you have agreed with the bank. If you want to come out and remove your money, generally, again, you'll get penalized. Again, if you invested in a treasury bill, you are stuck for that period. If you have urgent need for your cash back, you'd have to get it back, but 3% less. So at least you have liquidity that is ready. The other advantages are the small amounts that are needed to invest in a money market fund. The current amount for CIC unit trust is 5,000, but you can top up with as low as 1,000 shillings. Compare that with investing in a treasury bill where you require 100,000. So you're able to access investments that you would not ordinarily access by yourself. And then, most importantly, the issue of compounding. Every month you earn interest. That interest is then reinvested. So in the second month, you have interest and principal reinvested. So you have the element of compounding, as opposed to investing directly, whereby the banks, central bank, and corporates will give you just simple interest. So what is important is you need to be patient, be very consistent with your investments or your savings, and have two principles in mind. You work very hard for your money. Money must return that favor and work for you. Secondly, every time you spend money, you're either investing or consuming. If you're consuming, you're making somebody else rich. If you're investing, you're making yourself rich. Thank you, ladies and gentlemen.